Good morning, everybody. We'll give it about a minute for more people to log in, and then we'll get started with the presentation. Good morning, everybody. My name is Shivani Jain, and I head up the firm's tax department. It's my pleasure to now get started with the major tax updates which we have before year end. This is Tax with Sachs Q4. I'm going to start up with some housekeeping items, get over some disclaimers and the CPE requirements before I introduce you to the panelists, and then we go over the agenda for today. Our firm provides the information in this webinar presentation for general guidance only, and this does not constitute the provision of legal advice, tax advice, accounting, investment advice, or advice of any kind. The information provided in here should just be constituted as should not be constituted for without consultation with professional tax, accounting, legal, or other competent advisors. Before making any decision of any kind, you please consult your tax advisor who has all the pertinent facts relevant to your particular information. It's my pleasure to introduce you to the panelists today. We have with us, I'm going to go in the order of the presentation, Eddie Rivera, who has recently joined the firm's real estate and construction practice and has almost 20 years of experience. He frequently moderates and speaks in panels focused on various topics in the areas of taxation, real estate, and construction. Most recently, Eddie has spoken on like-kind exchanges, opportunity zones, and tax planning for construction contractors. Stephen Ehrenberg is a partner in the tax department, and he specializes in construction, manufacturing, distribution, transaction advisory, and e-commerce industries. He specializes in structuring of merger and acquisition transactions, planning for international tax strategies. Stephen is also a member of our pandemic tax force, and you would have seen him on numerous webinars throughout last year talking about PPP. Our next panelist here is Joy, who is part of our state and trust practice. She has more than 20 years of diverse experience as a wealth transfer strategist with an extensive background in recommending and implementing advantageous tax strategies for multi-generational wealth families, owners, closely held businesses, and high net worth individuals. Joy has authored and co-authored numerous articles, and she is on a lot of panels speaking on these topics. And finally, it's a pleasure to introduce you to Edwin, who recently joined our state and local tax practice. He brings nearly 2 decades of experience dedicated solely to state tax matters. He has provided his technical competencies to clients in various sectors, and some of them are manufacturing, retail, construction, transportation, real estate, asset management, just to name a few. He's also an adjunct professor in the California State University. So with that, I'm just going to go over the agenda and then the CPE requirements. Today, we are going to cover an overview of the provisions of the Build Back Better Act and how to best plan for the potential tax changes coming. And Eddie is also going to discuss some year-end tax planning strategies. Stephen is then going to go over the new guidance surrounding PPP forgiveness. Joy is then going to talk about what we can do with respect to gifting and state planning before year end and what we need to look forward to next year. And then finally, we are going to discuss the state transition to various entity level taxation. Before I get started with the polls, just to let you know that this webinar is being recorded and you will receive an email of the recording with all the slides. The questions, if you are not able to get to them, we will try to respond to that later in an email. For you to get CPE credits, participants must stay connected to GoToWebinar for the entire duration of the presentation. We expect this presentation to run about an hour, so I'm thinking you probably would get an hour of tax CPE credit. You must answer 75% of the polling question. If you have any difficulty answering the polling question, just hit the escape key to minimize your screen and try again. If that does not work, please type into the chat box and we'll have somebody assist you. The participant course evaluation is in the handout section of the control panel, and it should be downloaded, completed, and emailed to jtoshi@saxllp.com to receive the CPE credit. Her email address can be found on the form. So with that, Eddie, I'm going to hand it over to you. I'm going to actually go over the first CPE question. Who on this panel has been part of the most webinars in 2021? Is it Joy, Stephen, Shivani, or Eddie? Who on this panel has been part of the most webinars in 2021? I think I see a clear winner. Just going to call, we have about 17% of the votes in, giving it another couple of seconds. We're going to close the poll in 5, 4, 3, 2, 1. Yeah, 60% of you got it right. It was Stephen Ehrenberg, who probably, I don't even remember the count. Stephen, about like 50, 60?
Probably somewhere around there.
Okay. So with that, over to Eddie. Eddie, what would you like to advise our clients on, things we should be doing before year end? And then give us your views on Build Back Better Act. What do you think? The provisions of BBBR version 1 is very different than Build Back Better Act version 2 that has come out. And I think one big significant change is where a lot of clients are asking me is about the capital gain tax rate increases. So as you're going through your presentation, maybe you can, talk what you think is the timing of these changes in the provision, and, do you think it's going to be retroactive or when it would be effective? Take it over. Thank you.
Thank you, Shivani. An amazing host as always. Good morning to everybody. Thank you for joining us. I'm get into Shivani's questions and get to the Build Back Better plan toward the end of my presentation. Right now, I'm going to focus on specifically income tax planning. It's December. It's the end of the year. Right now, everybody's kind of taking stock of where they stand with regard to the taxable income, what type of income taxes they're going to look to be paying, whether it's truing up this month, January, or on April 15th. So one thing I always like to share with my clients, although this is not all inclusive, I call it the tax planning matrix. And depending on what the law changes are going to be, are we going into a higher income tax rate environment? Are we going into a lower income tax rate environment? These are kind of the things that I like to think about toward the end of the year. Obviously, gross income and gains and expenses and losses, we can do one of two things. We can either accelerate the timing of them or defer the timing of them. So as we start to think about what's going to be happening in 2022, oddly enough, the base income tax rates will not be increasing in 2022 based on the Build Back Better plan as it is. Originally, the ordinary income tax rate was going up to 39.6%. The capital gains rate was going up to 25%. As of November, Congress removed those provisions, so the current Build Back Better plan does not have those provisions. So as it stands now, we're going to be looking at income tax rates, capital gain rates, just on the rate, forgetting about other applications of the law, but just on the rate, we're going to be looking at the same rates. We can talk about surcharges and things like that, and we will. As I know some of you will say, well, wait a second, Eddie, we've got these surcharges, so the rate is going to increase. When we think about gross income and gains, accelerating timing, if we will have surcharges, depending on what the income level is going to be, if you're going to be in the $5 million, $10 million income level, there will be surcharges. We'll talk about that a little bit later. Then maybe you don't want to accelerate timing of gross income. You may want to accelerate your timing of gross income. Things to think about: electing out of the installment method for people who sold capital assets and other non-inventory assets. You may want to think about electing out of installment method if you're going to be a high earning taxpayer. You may want to look at changes in methods of accounting where you can accelerate the timing of certain income items. And you may want to think about harvesting capital gains this year. If you can save 5 points or 3 points, I think the time value of money, depending on what line of business you're in, is going to be worth it. In a period of rates decreasing, you would want to defer timing. And so, thinking about 1031 exchanges, making opportunity zone investments, again, looking at changes in method of accounting that are going to defer the timing. And the big one is deferred compensation. I often tell people there's a lot of planning opportunities on the deferred compensation side that I think it's to me, every time I meet a prospective client, it's probably the one item where a lot of people don't focus a lot of time on. If you're a sole practitioner, you have a small employee base, or even if you're not a sole practitioner and you have a small employee base, younger demographics, people can start looking at, may want to look at cash balance plans, look at funding your 401k plan, etc. I mean, these are all things that as we get to the end of the year, people should be thinking about, on the deferral side and the acceleration of expenses. For those of you who have heavy capital expenditures in manufacturing and distribution, in the real estate space, on new builds, on big CapEx spends, you may want to start looking at cost segregation studies. I think a lot of manufacturing and distribution companies don't look at this enough. The real estate industry takes heavy advantage of the cost segregation process. If you'd like more information on that, feel free to reach out to any one of us on the team here. Recurring item exception, basically prepaying expenses, taking advantage of expenses that would have been paid over the next 8.5 months. Think about paying them now and getting the deduction. If you want to accelerate the timing of expenses or losses, if you know you're going to have some capital gains now, you may want to harvest losses. Especially if the tax rate is going to be flat, you can harvest those losses now if you're not going to be in the surcharge brackets that we'll talk about later. Also on the expense and loss side, accelerating capital expenditures, construction equipment, if you're in the construction industry, professional services industry, computer hardware and office equipment and things of that nature. You may want to think about accelerating those items. And finally, the de minimis election, where basically we can write off items depending on whether you have a financial statement or not of capital items of $2,500 in the case of no financial statement, and $5,000 in a case of you having a financial statement. And lastly, deferred timing on expenses and losses. Obviously, you can age your payables if you're a cash basis taxpayer and not pay the expenses, and you can delay capital expenditures for really any business. I think the key is, in general, when you start thinking about the timing of, specifically for cash method taxpayers, the postponement of sending out bills and the acceleration of paying bills is a general tax planning strategy for cash method taxpayers. Next slide, Alex. So let's talk about some other items. There have been some small tweaks, some small changes, and then a little bit of a refresher. With regard to Section 163J, interest expense, the limitation during the pandemic changed. It was adjusted up to 50% for 2021, and forward now it's gone back up to the 30% of ATI. So your adjusted taxable income is generally your trade or business income, plus or minus other adjustments. For example, depreciation and amortization are added back, and then you can take your interest expense up to 30%. Couple things to note. The small business exception amount has gone up to $26 million for 2021. So if you are a small business, the interest expense limitation does not apply to you. That's up from $25 million from the past year or two. Also, if you're a real estate entity, you may be eligible to make the real estate election out of the interest expense rules, regardless of whether or not you're a small business. And lastly, I get a lot of these questions. I work with a lot of private equity firms. Tax shelters are not eligible, and so a lot of private equity firms where they have limited partners or limited entrepreneurs, they are not eligible for the small business exception with regard to 163J interest expense. So one quick planning tip here: when you're looking at 163J, if you're looking at your EBITDA numbers, something as simple as deciding whether or not something is a repair and maintenance expense, which counts against your EBITDA, or if it's capitalizable and is going to create depreciation, which doesn't count against your EBITDA. Little things like that, as you're kind of looking at the interest expense limitation, go a long way to really figure out what you're going to be able to, how much interest you're going to be able to deduct. So keep that in mind for people who have recurring maintenance and repairs in their business, and people who have big CapEx spend. Again, a lot of people in the real estate arena and a lot of people in the manufacturing and distribution space. Contractors typically don't have a lot of interest expense, although that's not always the case. But I really see a lot of contractors that are well capitalized try not to borrow too much and try not to have too much interest expense. So I won't go over that for now. Moving on to QBI, Section 199A. Just again, a refresher, United States and Puerto Rico sourced income. Two types. When we start talking about QBI, we start talking about specified service businesses. There's a phase out for high earners. That phase out starts at about $329,000 for couples married filing joint, and about half that for everybody else. A specified service business, for example, accounting, the medical profession, etc. If it's not a specified service business, for example, construction, real estate, manufacturing, the deduction, just as a refresher, is going to be the lesser of your QBI income, which is theoretically your trade or business income times 20%, or the greater of your W-2 wages multiplied by 50%, or the W-2 wages multiplied by 25% plus 2.5% of the adjusted basis of your qualified property. So very again, 199 DPAD was taken away. 199A was enacted into service with the Tax Cuts and Jobs Act of 17. Make sure that you are reviewing this and properly determining whether you're a specified service business or if you're not a specified service business, and make sure that you're properly computing your wages and the unadjusted basis of your qualified property. All important things. You don't want to lose out on this deduction. Believe it or not, we see a lot of people missing out on this still. So not any SACS clients, but certainly when we meet with prospective clients, we're always shocked to see how many people are still unaware of this. Next slide, Alex. So let's talk about and review our methods of accounting in general. I'm not going to go through percentage of completion or completed contract or anything construction specific, but I will talk about cash versus accrual. Cash method, small business rule, as I previously indicated for 2021. If you have average gross receipts for the prior 3-year period, so if your gross receipts average under $26 million for 18, 19, and 20, you're eligible to either continue to be on the cash method of accounting or to file a change in method of accounting to be on the cash method of accounting. And the benefits there are typically if you have a business where your accounts receivable outstrip or the aging, I should say, of your accounts receivable are greater than the aging of your accounts payable, you're probably paying tax on items that, and the AR is greater than the AP, you're paying tax on items that you haven't received yet, getting a deduction for items you haven't paid yet. But if your AR is greater than your AP and the aging is greater, you may want to look at the cash rule. In 2022, the 3-year average threshold goes up to 27 million. So typical, again, planning pointer with the cash method, the postponement of billings and the acceleration of deductible expenses. This is something that as we near the end of the year, you should be looking at. For example, employee bonuses. If you're going to pay them the first week of January, the second week of January, why not pay them in December? Maybe the office closes the last 2 weeks of December, and the bills don't get done, and so you postpone your billings administratively, and so you're planning for the cash method income. On the accrual side, make sure that you're taking advantage of the recurring item exception. Make sure you don't have any unrecorded liabilities, because you want to make sure that you're in general bringing down income. Now, again, I'm saying this now because we are not expecting the base tax rates to increase. We're not expecting a tax rate increase from 37% to 39.6%, and we're not expecting on the capital gains side a tax increase from 20 to 25%. Obviously, that could all change. The politics of what's going on in DC can change. Certain senators can decide to make changes in their opinion, and so we'll see. Next slide, please. So income tax planning with regard to capital expenditures, depreciation specifically. Again, if you're trying to accelerate expenses into the current year, you're looking at Section 179, which you have to elect into, and you're looking at bonus depreciation, which if you don't want, you need to elect out of. And so Section 179 for the current year, 2021, the maximum expense is $1,050,000. You have your phase out at $2,620,000. So for total capital expenditures over $2,600,000, your maximum expense for the year of $1,050,000 begins to decrease. Be very, very careful with the non-conformity rules. Every state is very different, and so you have to be careful when electing 179, as well as bonus, what the state conformity rules are. Or do they conform? Do they not conform? Is it an adjusted conformity, etc.? Bonus depreciation you can take with a property recovery period of 20 years or less. We still have 100% bonus depreciation for 21 and 22. 2023 and beyond through 2026, there'll be an annual 20% downward adjustment through 2027. I expect that to eventually change to just be, I would expect that this remains 100% bonus depreciation unless there's really big holes in the budgeting process where they need to remove the 100% bonus depreciation or take this down. In any event, obviously, if you're trying to accelerate expenses, you're going to elect into 179, and you are not going to elect out of bonus. If you wanted to defer bonus in Section 179, let's just say you have a business, maybe we have investors or partners or fellow shareholders in an S corporation where they're passive, and perhaps accelerating losses don't help them, or perhaps we have a feeling that tax rates are going to increase. Perhaps we want to elect out of bonus and let those deductions roll into future years, and maybe smooth out income over the next few years and take advantage of this expense, utilizing this expense against higher tax rates. Again, right now, that is not where we are. Lastly, the de minimis safe harbor election. It's an annual election. Typically tangible property, tangible personal property, typically, as long as that property's not more than $2,500. If you don't have an applicable financial statement, you are allowed to make an election to just write those items off and not capitalize them. For example, a professional service firm where you buy various pieces of equipment, and those items of equipment are less than $2,500 per item, you can make an annual election to not capitalize them and just write them off. Again, when you're thinking about 163J and you're thinking about EBITDA, you may or may not want to make this election depending on the management of EBITDA to get to a point where your interest expense is fully deductible. Next slide, Alex. Thank you. So a lot of changes the last couple of years that I think maybe a lot of people weren't focused on. I know our fellow partners here, we've talked a lot about this, but maybe if we have guests of the firm on this webinar, or we have perhaps other CPA firms showing up to see my face. Basis and at-risk limitation, review pass-through entity basis. For partnerships, within the last 24 months, we've had a conversion to partnership tax basis capital reporting. Double check, triple check, quadruple check, make sure the 2020 computation, the 2019 computation, whenever it was done, is correct. We don't want to be in a position where the tax basis, there was an error in calculation, there was an error in computation, and now all of a sudden, we have a basis or at-risk limitation. We're not able to deduct losses that we're entitled to. Also, another item that I've seen kind of, the treatment of it all over the place, exempt income increasing basis. We've had all different items going on, whether it was the EIDL grant or the PPP loans that were forgiven. Make sure that you're looking at those and you're properly taking them into account. They are non-taxable items. However, they are considered exempt income, and they are increasing your basis and giving you the ability to deduct, in the case of PPP, the expenses that were taken. We're kind of getting to the end now of PPP and the loan forgiveness process. Hopefully, for a lot of people, that's very important that when we're doing our tax projections and we're doing our tax planning, that we understand those concepts. Understanding client liabilities. This is a really big thing that I focus on. You're not really going to understand the client liabilities. This is for our team here at the firm and for our client base. You really need to understand the difference between, in the partnership setting, the difference between recourse debt, qualified non-recourse debt, and non-recourse debt. And I think this, the just simple misclassifications here can cost the taxpayer a lot of money. Recourse debt, generally speaking, is debt that a partner or multiple partners are on the hook for, or in certain cases, debt that a related party that is not a partner or a member in the partnership is on the hook for. So you have to understand the debt instrument. You have to review the notes, the agreements with the creditor. Qualified non-recourse is debt that is collateralized by real property. And non-recourse debt is debt that doesn't fall into the other two buckets. So very important to understand, because these items give you basis. All three of these items give you basis, but only two of these items, for purposes of taking losses, put you at risk and add to your at-risk, your amount at risk. So very important to understand this as we go through planning season. Next, an S Corp, same thing with the partnerships. Make sure shareholder loans are properly classified, and make sure we understand that we're going through that. So lastly, I'm going to fly through the next slide, please, Alex. We're going to talk about this briefly. Passive activity loss limitations. Real estate professionals. I get a lot of questions from people who are not in real estate businesses, but they dabble in real estate, or maybe they own vacation homes, multiple vacation homes. You have to have 750 real estate hours, which means you're spending 750 hours or more in this space, and then greater than half of all your service hours during the year. And then non-passive versus passive, make sure you keep track of your hours by business. So it's helpful to have a diary where you're keeping track of these items. Any questions on this, obviously, let us know. So we're going to jump right into the Build Back Better overview. Next slide, Alex. Then investment income tax, the 3.8% tax. Right now, as the Build Back Better plans bill stands, the net investment income tax on trade or business income, if you're married filing joint and you're going to have taxable income greater than $500,000, your income, your trade or business income will be subject to the net investment income tax. And what that means is, in the past, passive income or passive activities, income from passive activities and income from portfolio items such as interest, dividends, capital gain was subject to this 3.8% tax. Now with this bill, if it passes as is, trade or business income for high earners will be subject to the 3.8% tax. As you see the thresholds there. Important to note, grantor trust, or non-grantor trust, I should say, in the States, the taxable income threshold is any income over $13,000, much, much, much less than if you're married filing joint or non-married filing joint. Another thing to note, excess business losses from pass-through entities or sole proprietorships. If you have losses, the ABL rules were suspended due to COVID, due to the pandemic. They are being proposed again to come back with the net business losses disallowed and carried forward. Surcharges, we talked about this. Married filing joint, there's going to be a 5% surcharge on excess of AGI over 10 million and 3% on excess over 25 million. You may want to accelerate income into the current year out of 2022. Again, if it doesn't pass and you accelerated the income, you lost a couple points on the income, but this is something where it's risk management. You got to figure out the planning and what you feel is proper with regard to your cash flow. Non-grantor trust estate, again, a much lower threshold to pay this surcharge. Next slide, please. This slide is for people who are interested. This really doesn't affect our client base. Most of these clients can be publicly traded companies, much larger companies. The corporate alternative minimum tax of 15%. Just a slide to kind of give you an update of what's going on there, and the excise tax on repurchased corporate stock, again, for stock trade on established securities markets. So, with that, I think there's a lot of thinking that has to be done, a lot of planning that needs to be done. Will there be changes, will there not? Really, it's going to come down to what everybody's comfortable with. And with that, because I ate up a little more time than I should have, we're going to roll right into CPE poll question number 2. And I'll give it away to Shivani. Thank you, Shivani.
Thank you, Eddie, for that detailed presentation. CPE poll number 2, which state we do not have a SACS employee in currently? Florida, Texas, California, or Wyoming? We're going to close off the polling questions in the next 30 seconds or so. I have about 18% of the vote in so far. So please answer the questions. Okay, I think they shut down the poll. The results, yeah, 90% of you were right. It is Wyoming. So Steve, over to you. You want to give us on what the IRS is now saying about PPP and the basis? I think Eddie spoke to it about it a little bit on the basis piece of it.
Sure, thank you, Shivani, and good morning or good afternoon, everyone. So by now, most of you, if not all of you, to the extent you did receive first or second draw PPP loans, you're going through the forgiveness process. So hopefully that's running along smoothly. But one of the significant unanswered questions prior to the 3 revenue procedures issued last month was, when do I recognize the basis? As a refresher, the Consolidated Appropriations Act that was issued at the close of 2020 basically said that borrowers receive tax basis in the forgiven funds, but the question was when. Well, that question, as I said, has now been answered. And if you look at the next slide, Rev Proc 2021-48 basically gave taxpayers 3 options as to when you can recognize the basis: either when the eligible expenses were paid or incurred, when the loan forgiveness application was filed, or when forgiveness was granted. So that's certainly a big item for taxpayers and some flexibility there. And for those of you who are going through the forgiveness process or the tax return process, this is certainly something that's very important. The next Rev Proc specifically provided guidance for partnerships and consolidated groups, and basically indicating how your 704B, so how your income allocations and how your tax basis adjustments would work for partnerships, and basically it's honoring the allocations as long as they follow the rules of 704B and you're adjusting your partner basis accordingly. And then for consolidated groups, the subsidiaries in terms of how they'd recognize their basis adjustment. So if that impacts you, it's definitely something you're going to want to look at. And lastly, on the next slide, Rev Proc 2021-50, to the extent you're under the partnerships or under the CPAR, the Centralized Partnership Audit Regime, gave them an opportunity to file amended returns. You can do an administrative adjustment request as well, but oftentimes the amended return was easier to accomplish, as long as you file those amended returns by the close of this year. So that's coming up. You have a little more than 3 weeks. Hard to believe, but as long as you get those done by the end of 2021 and provide the partners with K1s, you can take advantage of the previous 2 Rev Procs that we mentioned. So a lot to breathe in, but just know that these are basically taxpayer-friendly items, and hopefully we can take advantage of them to the extent they impact you as we hopefully move past the pandemic. And with that, I'm going to turn it back over to Shivani. Thank you, everyone.
Thank you, Steve. Now, Joy is going to talk about some current provisions which we think are in the PPP too. Joy, so we started off in the middle of the year, right, with maybe thinking the exemption would go down to around $6 million. Grantor Trust, the provisions would be different. So everybody was in the panic mode. And now we are looking at the Bid Back Provision Act, and the provisions are significantly different. They have scaled back a lot of things. But then I think the area of concern, as Eddie mentioned, is the surtaxes which kick in at a very, very low threshold for non-grantor trusts. So over to you, and then your thoughts on the same.
Thanks, Shivani. So yeah, I was a little bit of the reason for some of that freak out. but I think that it was warranted, because a lot of the things that were coming out of Washington, a lot of the things that we were seeing were particularly scary. And I think that it's important to recognize that those things are not just gone. They don't just like vanish into the ether just because it's not part of the current proposals that are now being considered. The Congress legislators have been talking about reducing the exemption for some time, since it was almost doubled at the end of 2017. So I do think that there's a possibility that we could see before, in the next few years, some retro, some reversion back to a lower exemption. And for that reason, I think that if planning made sense before, it probably still makes sense now. But let's just talk about where we are currently, right? So 2021, the lifetime exemption, that's the aggregate amount that you can give away during your lifetime or at your death in the aggregate. So basically, we just like look back on your life and say, how many taxable gifts did you make? That's the amount in excess of those little gifts, the $15,000 checks that I'm hoping everyone will send me, after this presentation, because of how awesome I am and how much you want to donate to my cause, which is just like, me. But $15,000 is the de minimis amount that you can give to each person that you know, and that would not add up onto that aggregate amount. Everything over that is going to keep accumulating over the course of your lifetime, so that at your death, we look at your estate and say, okay, what's the value of your estate less all the gifts that you've given in your lifetime? To the extent that that exceeds $11.7 million, there's going to be a tax. And that number goes up to $12.06 million per person. As of currently, the current law right now will have that going back to about $6 million starting on January 1st, 2026. So in real dollars, what that kind of looks like is, if you were to pass with a $12 million estate on December 31st, 2025, you would have no estate tax. If you were to die the next day on January 1st, 2026, assuming no change in the law, then you would have about a $2.25 million estate tax. So the numbers can be pretty significant, and people should be thinking in terms of, if I was ready to make gifts before, I might want to make gifts now, because the only two ways that you can use the lifetime exemption amount is by dying or by making taxable gifts. I recommend the latter as opposed to the former. Could you advance the slide, please, Alex? But right now, what we're looking at, as Eddie mentioned, is a significant surcharge on trusts, on non-grantor trusts. And a lot of you are saying, well, yeah, but I have a grantor trust. You've already told me about this. I and the trust are the same person for income tax purposes, so the trust income is going to be taxed at my rate. And fortunately, I get to pay the taxes on it, which is awesome, because I listen to Joy and I know that's actually a good thing. Well, that is true. However, every grantor trust is eventually going to become a non-grantor trust, unless you've figured out a way to avoid death. So as a result, we're looking at these non-grantor trust provisions and we're a little worried about them. You really want to be thinking about ways to reduce the overall income tax for the non-grantor trust, because Build Back Better does include some provisions that will change fiduciary income tax rates. They're always imposed at a much lower threshold than for individuals. In this case, 5% surcharge on income over $200,000, 8% surcharge on income over $500,000. So you might want to consider putting in provisions that will allow your trustee to make charitable contributions in a given year. It needs to be worded in a specific way so that this will be a deduction against the income that is earned by the trust. You might also want to look at your beneficiaries and maybe widen the class of beneficiaries, so that if a particular beneficiary is maybe going through a divorce in a year or possibly has some creditor problems, maybe you can make a distribution to another beneficiary, and that way you can still reduce the income at the trust level but get it out to your beneficiary. So it's a good idea. Once again, I think I've said this every time I've ever talked to you, is that you really want to have people at the table who have, an eye on these things and who come at it from different perspectives. You want to be sitting in the room with your advisors, your attorney, your accountant, your financial advisor, and your insurance agent, if that's applicable, so that we can really come up with the best plans from our different disciplines and put forth the best plan for you. I think that it's really unknown right now, as Eddie pointed out, what might happen in Congress, but there has been a lot of talk for some time, so we can expect some changes on a going forward basis. A couple other things I just want to mention, or actually one other thing I just wanted to mention, because I know I'm running short on time, is that there are things that the president, that the executive branch can do without congressional authority. One of those things might be bringing back those valuation discount regulations that scared us all a few years ago. And as a result, if you do have assets that you're looking to transfer, while we know what the laws are, while we're still in this world where valuation discounts are still available, now is the time to do it. Thank you all very much for your time and attention, and I hope you enjoy the rest of the year. Thank you. Back to Shivani.
Thank you, Joy. We'll get the third CP poll out of the way. Which is not a SACS entity? S2 Solutions, SACS Wealth Advisors, SACS IT Advisors, SACS Capital Advisors. We have about 40% of the votes in. Alex, can you close the poll, please? The answer here is SACS IT Advisors is not a SACS entity. 53% of you got it right. So with that, Edwin, in the Build Back Better Act, the latest version, there is talk about increasing the SALT limitation from $10,000 to $80,000. You know, there's talk maybe the number is going to be around 40, 50, it could be 80. But then a lot of states, I think about 18 or 19 of them, have started to enact the entity level tax. Every state, the rules and regulations are different. So why don't you just walk us through some of the main states? I know you can't go over all the 19 states in the 15 minutes presentation you have left, but maybe just highlight a few key factors on the different states.
Shivani, I would actually love to go through all 20 states. We can extend this to maybe 2 p.m. But you bring up a great point, the Build Back Better plan. I mean, there's a bill right now that's looking to expand the SALT cap. It's passed House, it's in Senate. So if that SALT cap is increased for federal, it may potentially have an impact in the calculus here when we're deciding on whether to make an election at the state level for the entity level tax. As mentioned, and as most of you have probably seen, states are moving towards this entity level PTE tax. And as has always been the case in the state arena, 1 or 2 states enact something and it really catches on like wildfire, and other states sort of start picking up something similar. It's what's been happening here with these entity level taxes. As you are all well aware, the key intent here is to design a workaround to the $10,000 state and local tax deduction for federal purposes. Again, as is standard in the state world, the fundamental or the base framework of the tax is similar across the states, but the details differ because every state has a different way of doing things. And we'll take a look at some key states and see what those differences are. Can we go to the next slide? So 23, as of right now, 23 states impose some sort of entity level tax. 4 of those states we're going to carve out. We don't want to talk about them because their entity level taxes is not elective, it's mandatory. And if you've worked in the state and local tax compliance arena, you've surely come across Tennessee, New Hampshire, DC. in their NV level tax. So we want to focus on the states that have enacted the elective tax. And with that, we can go to the next slide. This is a listing of the states, just for your information. I think we can pass this slide as well. We'll look in a bit more detail. These are the 3 states that we picked that we'll review in a bit more detail. New Jersey, New York, California, they tend to come up quite frequently. Let's go to the next slide. So here is sort of, when you walk away from this training, I wanted you to take away some sort of analysis framework for yourself, because chances are you're going to be looking at more than the 3 states we're going to talk about today. So there's 7 key points that you should look at, and they're enumerated here. You want to understand the enactment start and end dates, if any. You need to understand what is an eligible entity that may make the election. What is an eligible owner that may participate? How is the election made? That's very mechanical and generally straightforward. What is the tax base? How is the tax computed? Is it apportioned? Who is it apportioned for? What are the credit and withholding rules? Now, this is very, very important. What's the benefit of the credit? How does the credit operate? What can the credit offset? What are my limitations? And then what are the withholding rules? Withholding regimes have existed since the beginning of time, but unfortunately, as you'll see, they have not been taken away for partners or members that are electing to participate in this NB level tax. So that's going to cause some issues, as you'll see. And then finally, what are the unintended consequences? Move on to the next slide, please. So here with New Jersey, right, the New Jersey PTE regime is going to be operative from 2020 forward. The eligible entities are partnerships and S corporations. Single member LLCs, sole proprietorships cannot participate, and you'll see that you'll see a little trend building with eligible entities and eligible members and partners as we move forward. For New Jersey, the election can be made by an authorized signatory of the partnership, so you don't have to go through the headache of getting individual consent from the partners. Next slide, please. Very interesting with New Jersey, here's a pitfall. The tax has to be calculated on every member of the eligible partnership or entity that may elect. That's very problematic, especially on the second bullet point, right? If you're dealing with an exempt organization, they too have to participate. They will have an entity level tax computed on their behalf. The guidance for them is, hey, file a New Jersey return and request a refund. So, you know, even an exempt org is gonna, A, park its money in the New Jersey coffers for a year, and then B, have to file a return where historically they never did. So that could be a bit of a headache there. Moving on. So the election, as we discussed, can be made by an authorized signatory or all eligible partners. It's an annual election. It's not retroactive. You can revoke before the original due date. And of course, the elections the eligibility to make the election started on 1/1/2020, so last year. Next slide. So qualified net income is essentially the distributive share of income that's subject to the New Jersey personal income tax. One key point to take away here is the middle bullet. For tax year 2020, the Department of New Jersey's interpretation of the tax base was that it should have been calculated on federal taxable income, which was very problematic because there is a very big discrepancy between federal taxable income and state taxable income or New Jersey taxable income due to Fed tax or Fed state tax differences. This has been corrected, and it was the intent of the legislature to make that update and to only include income that is post adjustments, so post adjusted federal and not just federal income. For 2021 tax years, the entity will compute the entity level tax using the items on the New Jersey K1 that will be prepared with your New Jersey 1065. Generally, the income is post apportioned, so that's there's no surprises there. Next slide, please. At least for individuals, the credit here appears refundable, and however, for corporations, they get a carryover of the credit, and it's not so problematic for a corporation because generally a corporation will be a New Jersey filer, will have a New Jersey taxable income that they can use the credit to offset. There is a problem here that is being worked on, in that S corporations have to be withheld upon as well, and an S corporation will never have New Jersey net income, so the credit essentially gets trapped. I think that was an unintended consequence that is being worked out. I believe it should be worked out for 2021. Now, regular withholding is also required, and that takes us directly to the unintended consequences. The big issue here is cash flow, and it's going to continue to be a big issue with all the states that have this tax, in that the tax is computed at the partnership level. So it's the total amount of tax is what the brackets are going to look at. So what that means is that a partnership may end up paying tax at 10.96%, and the partner at the individual level may be in a 6% bracket. So what that ends up doing, along with the requirement to continue regular withholding, is create a very big cash shortage for your partners that you want to be aware of. We can move on to the next slide. The enactment dates and eligible entities for New York. Enactment date for New York is 2021. Eligible entities very similar to New Jersey in that it's partnerships and S corps, can't be a PTP. So an authorized person can go ahead and make the election, and the election can be made even if there are partners that are not eligible to participate. So moving on. Eligible partners are defined as Article 22 taxpayers, and Article 22 taxpayers refers to taxpayers that are subject to the personal income tax, as Article 22 of the New York Code is where those provisions are codified. So essentially individuals, what's interesting and unique with New York is that if you have a partner that's a single member LLC, you can look through the single member LLC, and if the single member LLC's sole owner is a Article 22 taxpayer or an individual, the single member LLC may participate. Moving on. The election, this is very straightforward mechanical stuff. I won't spend much time on it, but I will note that the election for 2021 was due October 15th. If you haven't made it by now, then you're not eligible. But for 2022, your window to make the election is January 1st through March 15th of 2022. So next slide. The tax base here has a nuance between whether the electing entity is an S corp or a partnership. The key takeaway from here is that, much like California, where you have individuals, you put them into separate buckets. The distributive income that goes to the residents is not apportioned, which is correct. So they'll pick up 100%. The distributive income going to your non-resident partners will be apportioned. So for obvious reasons, that's the correct way to handle this. I did put the service bulletin there for you. There's a reference if you want to take a look and see the computation in a bit more detail. The credit appears to be refundable in New York, so that's a good thing. And again, like New Jersey, regular withholding is still required. But the good news with New York State, unlike New Jersey, is that if your partners qualify, you may request a withholding exemption for your non-resident partners, so you at least relieve them of the cash crunch of being withheld upon, and also, having this elective tax paid on their behalf. Moving on. So, I think we've talked about this, and there's really not much point in going through it, but you still have the same cash flow problems that you need to consider. And then moving on. California, very similar to all the other states. And what I want to focus on in California is really some of the key factors to consider. The election, the tax base apportionment is identical to the other states. Can we go to the next slide? One more slide. One more slide. And one more slide. Here is what I want you to focus on, what I want you to know. The California credit is non-refundable. That is very, very problematic. It has a 5-year carryover provision. The credit cannot offset tentative minimum tax. So if you're non-resident and has California TMT, there is a possibility of this credit getting trapped and never recuperated. It's also more problematic if the partnership has a 2-year running nexus and they do the election and then nexus stops. So they don't file in California anymore. Now your partner may have carryover credits that are stuck and will expire in 5 years. So be very careful of that. Next slide. Take a look at these unintended consequences. I think this is a good reference guide, but it really touches on what we just spoke about and also some of the cash flow problems that can pop up here. Moving on. So again, just like everything else in the multi-state tax world, it's really important to do a detailed analysis before making the election. The one thing you take away here is don't just make the election because it seems to be convenient or it looks like a good idea, because it's kind of like dealing with the devil here, where you think you're getting a good deal, but some of the details may go against you. Next. So again, key takeaways, I think we touched on. Feel free to sort of review this at a later time, and we can go to the next slide. And I think we can stop here. This last slide is just other miscellaneous things that are happening that I thought were interesting that you should be cognizant of. Washington State is imposing a capital gains tax. There's a $250,000 exclusion, so anything in excess of that. We talked about the Build Back Better plan, the $80,000 SALT cap expansion that may change the calculus of this analysis. North Carolina has gone through a very big taxing regime, and they have now also implemented an elective partnership level tax. So that makes 20 states. And then California is doing some interesting things with marketplace facilitators, essentially making them pay more taxes other than sales and use tax on behalf of the marketplace sellers. So if you are or your clients are marketplace facilitators, this is a trend to probably keep in the back of your head, because like I said, it's probably going to expand like wildfire going forward. I think with that, I can go ahead and conclude and give it back to you, Shivani.
Thank you so much, Edwin. Let's try to get the last polling question in. How did you hear about our webinar today? Email, social media, personal invite, or others? If you're looking for CPE, please try to get your votes in as soon as possible. Probably close it in the next few seconds. Alex, you want to close the poll? Yeah, 83% of you said via email. So we didn't have, we don't have time to answer most of the questions, but I think a very common question was asked was, how do we get these slides? If you signed up for the presentation, an email will go out to you with the recording of this webinar as well as the slides. So with that, thank you to all our panelists for all your great insights today. This is the last SACS with Tax webinar before the year end. So as we sign off, wishing all of you a happy, healthy new year from the SACS team here. Thank you.
Bye, everyone. Thank you.